Coming up on this episode.
What are derivatives?
It is a promise that in the future, we will do what we agreed.
What if I change my mind?
Everyone has his own perception on how the market is going to move.
How does the person who wants to get into the contract project and say, I want at 42?
That guarantee fund can never be bigger than the market.
What's the process they would go through? Where would they begin? Hello there and welcome to the ISIFA Investment Show. My name is Rina Hicks. I'm the Operations Director at FIDA Investment Bank and the host of this show. And today we are looking at derivatives. A lot of people have asked us, could you cover derivatives? And we have heard you. So today we have the expert on derivatives in the capital markets in Kenya. So we are so excited to have with us Peter Onyango. He is a principal specialist risk and stress testing at the Capital Markets Authority in Kenya. He is actually the person at the authority who was involved in setting up the derivatives market in Kenya and is here with us today to take it back to the basics. We're going to start from the beginning. What are derivatives? How do they work? And I can't wait to get into it. Karibu sana, Peter. Thank you for being here.
Thank you, Rina.
Yeah.
Thank you so much.
So before we get into it, I like to ask my guests to tell us a little bit about themselves because, there's details I don't know and it's fascinating to just get to know people. So tell us a little bit about you. Okay,
thank you, Rina. Okay, I am a regulator. Currently, I work for Capital Markets Authority. I was recruited around 5 years ago to assist in setting up the derivatives market. This was, of course, I wasn't alone. We were a group of 5. My part of the role was to ensure that the structure is robust, to ensure that the risk management side of the market actually is robust and strong. Of course, now we went live in around June, July 2019. And after that, now, then my roles increased, and I was also told to also confirm and check on the equities market to make sure that it's also strong and robust. Yeah.
And so your role, we talk about you being the principal specialist in risk and stress testing. What does that mean?
Yes. Now, we all know risk.
Yeah.
Maybe the part is we don't understand is the stress testing part. You see, when you have a market, whether it is the derivatives market or the equities market, there's always a guarantee fund that is used whenever there's a fallout. The market has collapsed and we need to look for money to pay people. So that guarantee fund can never be bigger than the market. It's always a fraction of the market.
Yeah.
So how do you ensure that amount is enough given the risks in the market?
Okay.
So, for example, if you're saying that you're going to have, let's say, four brokers, and the probability of all of them collapsing is not possible, you'd say maybe, can we have enough money to cater for two brokers, 2 of the biggest brokers? And can you confirm, can you stress and see that this money is enough if something happens? So that's basically now where the stress testing comes from.
Fascinating. We'll need another session just to understand how the stress testing is done. But anyway, for now, we are speaking about derivatives. And let's start from the beginning. What are derivatives?
Okay. A derivative is they always say it's a contract. So it is a promise that in the future, we will do what we agreed. So in the financial world, if we agree that I'm going to sell to you a piece of shares, maybe Safaricom, at a particular price, at a particular date, that is what we are calling a derivative. Because that contract is a contract, but it's based on the movement of the shares.
Yeah.
So its value depends on what is the value of Safaricom at a particular point.
Okay.
That is what is a derivative is about.
So let's just proceed further, because you talked about the value of the derivative being based on what we think the price of Safaricom is going to be.
Yes.
Perhaps you can give an example using Safaricom still.
Oh, okay.
How does one derive the value that the contract for delivering or getting Safaricom some point in the future is going to be X? How does that come about?
Okay. What normally happens is, for example, let's say Safaricom is 40 shillings right now.
Mm-hmm.
So I would say I want to purchase Safaricom 6 months from now at 42. Already, that is what a derivative is. It's already saying that I promise that 6 months from now, I will buy Safaricom at 42. Now, every day, a valuation is done to see where is Safaricom right now. So if right now Safaricom is 40, and I said I was going to buy at 42, then I'm not in a good position. But as the maturity date is coming, that 6 months is arriving, and by good luck, Safaricom, the underlying, which is Safaricom, is now 43. It means that I am buying it a shilling less.
Yeah.
So it means I'm in the money. It means that the value of my contract is actually valuable.
Yes. And
you know, when you're buying the contract, someone else is selling it to you. So it means the person who has agreed to sell it to you at 42 is not in a good position, because the market, the value of Safaricom is 43.
Yeah, so he's selling it at a shilling lower.
He's selling it at a shilling lower. But I am in a better position because I bought it. I have the contract that says I'm going to buy it lower.
What if I change my mind? I don't want to buy at 42. Because now the price is 38. I want to buy it at 38.
Yes. So what happens? Very funny. And that is why the risk management comes. Every day, there's going to be a valuation to see, so what is the value of Safaricom at 4 o'clock in the evening. And so that if Safaricom moves either up or down, then the buyer and the seller has to continue to provide some additional margin, so that to ensure that they're still in the deal.
So additional margin, for those who don't understand.
There we go. I think let me start with the terms first.
Yes.
Okay, when you enter into a contract like that, you first need to deposit money with the broker.
Okay.
And the brand money is called initial margin. Initial margin is calculated, it's around maybe 8% of the value of that contract. That initial margin is put to ensure that, and it's put by both sides, by the buyer and the seller, just to ensure that there is a deposit, a good faith deposit, that no one will really go out of the deal. So, and now with the initial margin put aside, and every evening a valuation is done by the NSE to see where the value of the contract is and the value of the underlying, and to see who needs to add more, top up more, depending on where the market has moved. So as I was saying, for example, if the contract said that I will buy Safaricom at 43 in 6 months' time, and unfortunately Safaricom has moved from 40 to 41, it means that the seller needs to now add money, because he is in a position that he can get out of the deal. He needs to add some additional margin. So in that way, every day people are just ensuring that the other person does not get out of the deal, which makes it possible in the end for everyone to get what they promised.
Yeah.
Yes.
So every day, depending on the movement of the price of the underlying stock of Safaricom at the stock exchange,
yes,
the broker then calls the buyer or the seller that they need to top up their margin based on whether or not the price has moved. If it hasn't moved, then nothing.
Then it's fine.
How does the person who wants to get into the contract project and say, I want at 42? Is it because let me just ask
Yes.
it that way. Yeah.
Okay. It's all about it's all about your analysis as an investment analyst. If you think that it's all about how you believe the market is going to move. If you think that the Safaricom price is going to go up, then you'd rather buy the contract. You buy the contract, because especially because even the derivative contract is much cheaper to buy than the equity itself. It is extremely cheap.
Yeah.
In terms of transaction costs.
Yeah.
So you'd rather take a position in the derivatives than actually buy the contract itself, if you want. So the other way, also the other guy who's selling, maybe he also believes that the price is going to go down. You know, the markets are moving up and down, they're volatile. So everyone has his own perception on how the market is going to move. Now, what I've explained is actually called speculating, because you are speculating that the price will move up or down, and you take a position because of that. However, there are also other people who take a position in the derivatives for hedging purposes.
Okay.
Now, hedging means someone who wants to protect what he already owns. So assuming, let me give you an example. Assuming we have a major shareholder for a company, say KCB. So this is a guy who even has board membership, is that big. But that means that he actually has the asset. He has the equities with him. So he's long on the equity. He has the equity shares. He has a board position. Now, for any reason, he believes that, hey, things are thick. He has seen that maybe the central bank governor has said they're going to be interest rate cappings. It is already published information, interest rate cappings are happening. And the market is still reflecting to see what will happen to the banking industry. If he believes that, oh no, I need to protect the value of my shares, because maybe next week or the week after, he's closing his books, his financial books. So he would like it to show that he has a good position with him. But he also doesn't want to lose out on his board membership. So generally what people used to do is that they used to sell the share quickly. But if he sells the shares, he loses his board position. So what does he do? He will do a hedging. He will hedge in the derivatives market. So what he does, because he's hedging, he will do, because he already owns the share, so he's long in the share, he will actually go the opposite in the derivatives market.
And sell.
He will sell. He will go short on the derivative. So that if the value of his asset goes down, then the value of his derivative goes up. You add that together, he's actually hedged. He can decide he wants to make it 100% hedge, where he will not make money. Generally, it'll just be the same. Or he can make even a 50% hedge, where he will be protected 50% of the time.
Okay.
Yeah, so there are many strategies that you can do in the derivatives market that can protect you as an investor.
Okay. Okay. Thank you for that. What are the different kinds or types of derivatives that are available in the stock exchange at the moment?
Yes, I'm glad you said stock exchange, because there are actually two types of derivatives. Okay. We have the off-exchange derivatives. Those ones are they're also called over-the-counter. And then we have on-exchange derivatives. So this topic is mostly about on-exchange derivatives, where currently the Nairobi Securities Exchange is offering futures contracts. Now these futures contracts, they have different underlyings. One of them could be the index, the 25-share index. The other ones they're called single stock. So you have a futures contract on Safaricom, on KCB, on most of they're mostly the top liquid shares that is currently trading on the NSE. Yeah.
Okay. So you talked about different strategies. So if we use the example of the stock exchange, I love the one that you gave on the hedging. I think that makes a lot of sense.
Yes, thank you.
So that then, especially for someone who has to mark to market, the gains from the derivatives counter the losses in the market value of
of the asset. Yeah.
And I'm just wondering, what other incentive would I have for trading in derivatives besides speculation and hedging?
Okay. You can invest the same way someone would buy Safaricom just for investment purposes. You can also actually just buy the Safaricom contract and hold it for investment purposes.
For the full 90 days?
For the full 90 days, and then you roll over. You continuously roll over your contract.
Tell me, why would somebody do that as opposed to go straight to buy the stock at the stock exchange, the underlying?
Thank you so much. That's a good question. And that question has to come with a description of what it's going to happen. You see, let's go back to Safaricom. If you want to buy 1,000 shares of Safaricom, you actually need, and assuming Safaricom is, say, 50 bob, you actually need, no, let's call it 20 bob, it will be easier for me. You need 1,000 times 20, that full amount to buy the Safaricom shares.
Yes.
And then not only do you need that, but you also need to provide the transaction fee.
Yes.
Which is, of course, the fee that the broker fee, NSE fee, also regulatory fee, all those things.
Yeah.
So it comes up to the full amount that you need to produce. But if you decide to go buy the Safaricom derivative, you'll only be required to produce at most 10 to 11% of that amount. So if that amount was 20,000, around 10% will be, let's say, 2,000. You see? So you are paying 2,000 as initial margin to have an exposure of something big that is more than that 2,000. So you actually make more money you will have more exposure with your money than if you actually go to the equities market.
Yeah, directly.
Okay?
Yeah.
But of course the advantage of the equities market is that you will take part in voting process because you are actually a shareholder. You'll also be receiving dividends when the dividend is issued. That one, you see, that's the advantage of paying all that money in the equities market.
Yeah.
But in the derivative, you are more about, I want to make money from the movement of Safaricom, from the volatility of Safaricom.
Yeah. Okay. I guess the question then now is, who are the people you're seeing participating? I mean, since 2019.
Yes.
We're going on to 3 years now. It's been maybe 2.5.
Yes.
Who are the people who you find participating in the derivatives market in Kenya?
Okay. In the derivatives market, when it was launched around 2019, initially it was more about the retail clients, people who saw an opportunity in the derivatives market. And then we had high-end retail clients who came in, who are also taking part. And then lately, we have been having some, I don't know if you can call them hedge funds, but we have, big funds that are also there, trying to hedge the exposures, also doing some speculation, making money from what they think the movement of the share price is going to be. So it is a journey. It's a journey. I cannot say that we have a lot of corporate clients, because they are also, we are all in a learning curve in Kenya. So we're expecting the corporate clients to come in slowly by slowly. But right now the derivatives market is actually being driven by retail, high-end, and even the derivative brokers themselves, they also take part in the derivatives market. We also have a market maker who is there to ensure that there's always someone, if someone wants to sell, he will always buy.
Yeah.
So there's that opportunity for him to also, for that market maker to also bring volumes in that market.
Yeah. Okay.
It's a new market, so it's still growing.
Who would you recommend it for? I know that there's retail clients who are participating. You know how in any product you
Yes.
have the innovators, you have the early adopters, you know, and it continues then finally to the laggards.
To the laggards.
Let's say, for example, for somebody who's has a little bit of money, they're not sure whether or not to participate in the derivatives market. I kind of want to get a sense of who are the kind of people you would actually recommend for them to explore investing in the derivatives market.
I think we also have to agree that the derivatives market is just like even the equities market. You don't just enter with your eyes closed. So, for example, it's like we say that a Mercedes is safe. But would you drive a Mercedes wearing a blindfold?
No.
You wouldn't. So in anything, you need to actually educate yourself, learn how the market is moving. We also have licensed investment advisors in Kenya who can also advise you on the best thing to do. This one I'm talking about retail clients who really don't know how the market is run. It's important that they get the correct advice and they expound on their knowledge before they enter into any contract, even if it is shares.
So for somebody who's looking at investing in derivatives, what's the process they would go through? Where would they begin?
Oh, okay, that's a nice one. So if more about the customer journey, I think what happens is if someone wants to invest, we hope first that the person knows what he wants. Even if it's a retail investor, he has done his homework, he's talked to an investment analyst, a licensed one by CIFA and also CMA. And after that, the client would reach out to one of our derivative brokers. The derivative brokers, some of them are the same that also help in brokerage of sports, but we also have some new ones. For example, we have some online forex brokers who are also derivative brokers. So they would come to the guys, to the office of that entity, and just say that they want to do it. There would be the process, the normal process of finding out who you are, you know, the normal KYC that you would have even if you go to open an account in a bank. There's some things that you'll be asked for. They'll do some KYC checks, you'll sign some forms, and then they will now give you access to now deposit some money into, you know, you have to have money to invest.
Yeah.
So they'll tell you where to deposit that money. It will not be in cash. It has to be in electronic form, either in M-Pesa or fund transfer. And then after you've deposited the money, they will now tell you, okay, with this money you've deposited, you can now take part in the exchange, in the derivatives market. So hopefully you know what you're doing. As you said, in the derivatives market, it's almost like driving a car. You cannot, it would not be advisable, even if a Mercedes is safe, for you to drive with blindfold. So you have to have your eyes open, you need to know what you're doing, and you instruct now the broker to either buy for your contract or sell for your contract. And then you will be receiving regular statements, and if you are required to provide the additional margin, they will actually call you. They'll call you, tell you that your position is not moving the way it should, the way you're hoping. I need you to add some margin. Or if you are in a good position, they won't call you. They won't need to call you. Yeah.
I think that's clear. Where is a good place for somebody to get additional information on the practical aspects of trading in derivatives?
Yeah. Oh, okay. I would advise that the individual would seek an investment advisor if he's still shaky, or could actually go to the Capital Markets Authority website to look at the list of derivative brokers. They can either do that or even check the website of the NSE. That is posted in both places, and pick a derivatives broker that you feel can work for you, or even 3 or 4, and visit them, ask them questions. ask them what are their charges, what's the turnaround time, questions like that. Then make a decision and decide, okay, I prefer working with this. Or I can even work with 2 brokers if I want. Let's see which one will be faster, which one will make me feel nice, and just continue trading like that.
Yeah.
Yes.
The other day I was listening to Dr. Tedros, who's a WHO, I think it's Director General, and he was sharing how, the fact that COVID has stayed for so long is actually quite detrimental. And the effects of COVID on economies will be felt for a long time to come. For somebody who is thinking about investing, and this is a general question for you.
Yes.
Wondering, do I wait till COVID ends? Then we have an election here in Kenya. What do I do? What advice would you have for them?
I think due to the volatility around COVID, there are people, as I had mentioned before, we have the speculators. Those guys, they love volatility. That's where they make their money. Yeah, they make their money when the prices are going up and down. They try and they come in at. Another thing with derivatives, because the cost of buying the contract is very low. It means someone can go in and out, even during the day. So, if the value of the contract moves up, they can quickly sell the contract.
Because the transaction fees are low.
Yes, transaction fees are low. If it goes down, buy. Goes up, sell. Goes down. So there are those types of people who make money in volatility. In the contrast, there are those kind of investors who, remember, you need to protect what they have. So when they see volatility, that's when they'll enter the derivatives market to try and hedge what they have. And then there are also others who want to invest. So they will go just take a long position in the derivatives market and relax, because they know that the volatility will continue up and down, but generally it's moving up. So we have those kinds of investors, and they all have their reasons why they would want to invest in both the stock market or the derivatives market.
Thank you so much, Peter. It's been an honor speaking to you. I wish you all the best as you complete your PhD in a very short while.
I hope next time when we have a discussion, now you'll be calling me doctor.
Absolutely.
Thank you.
And in a very short while. Ladies and gentlemen, thank you for sparing your time to watch this video. And if you didn't know anything about derivatives, now you do. You understand what they are and how to trade them. I encourage you to seek out more information, speak to us investment advisors who are also members of ISIFA. And that's why ISIFA is doing this, to let you know what products are available, how they work, and how you can access them. So don't be afraid, because it's a season of a lot of volatility or perhaps not much going on. There are opportunities at every single point in time. So seek them out and you'll be able to invest to secure your future. My name is Rina Hicks and you are watching the ISIFA Investment Show. Bye-bye.